Alberto, thank you very much for this very, very kind introduction. More than anything, also for the very kind invitation to be here today and to be part of the Homer Jones Memorial Lecture. And it's a real privilege to add my name to the list, very long list of distinguished speakers that has been in this series celebrating the legacy of Homer Jones. And well, of course, I always enjoy very much interacting with Alberto. I learned a lot from him also in his different incarnations. And the most important thing is that he's somebody who honors his word, because when he called me to invite me to this lecture, I established one condition, and the condition was that I demanded to have St. Louis barbecue. And he delivered already. We had a very nice lunch with St. Louis type of barbecue. It really is excellent. So now it's my obligation to deliver. So now it's on me. So let me start. As many major central banks, including the Federal Reserve, are conducting reviews of their monetary policy frameworks, it is a good moment to take stock of the lessons that they should draw from the events of the recent past. As I speak today, inflation rates are at last returning close to central bank targets. Credible price stability objectives pursued by autonomous central banks, often in the form of inflation targeting, have been instrumental in achieving this. A key lesson for the success and durability of inflation targeting regimes has been their adaptability too. Regular reviews of monetary policy frameworks can provide practical guidance to help refine the implementation of inflation targeting in an ever-changing macro-financial environment. In my remarks today, I will discuss the key features of modern monetary policy frameworks which helped central banks around the world curb inflation. I will touch on insights from the 2021 framework reviews and how lessons from the recent inflation surge can inform the current round of reviews. So let me address first the key features of modern monetary policy frameworks. Central banks have made remarkable progress in curbing inflation over recent decades. During the Great Inflation in the 1970s, central banks' failure to combat emerging inflationary pressure saw a high inflation regime take hold. Restoring price stability on that occasion required a strong commitment and forceful action by central banks and came at a considerable cost to output and employment. Starting in the 1980s, central banks adopted more robust and credible monetary policy frameworks, which eventually evolved into some form of inflation targeting. This helped cement the transition to low and stable inflation. Inflation targeting regimes share some important characteristics. Setting clear numerical targets for inflation, backed by a credible commitment to achieve them, helps ground public expectations. Indeed, if sufficiently credible, the inflation expectations of households, businesses, and investors are the inflation target. Central bank autonomy is also key, as it allows central banks to act based on economic considerations, free from political interference. Transparency and accountability further bolster central bank autonomy and contribute to low and stable inflation. But there is no one-size-fits-all when it comes to inflation targeting. Central banks differ in the level of the target they set. They also differ in the amount of flexibility they have to achieve these targets. Some central banks focus purely on inflation. Others also take output stabilization, full employment, or financial stability into account. Similarly, some central banks tolerate deviations at a point in time, for example, through tolerance bands for the inflation rate. Others have longer horizons over which the inflation target is to be achieved. Approaches differ across jurisdictions according to the prevailing macro-financial landscape. The experience of emerging market economies is a case in point. While flexible exchange rates help absorb shocks, large and sudden swings in exchange rates could cause strains in domestic financial markets. Therefore, policy frameworks in emerging market economies often allow for some use of foreign exchange intervention and macroprudential tools. In sum, there seems to be great value for central banks in having an inflation target, but a range of design choices seem to be compatible with sound inflation outcomes, and the most appropriate design will vary across countries and could even evolve over time. Regular monetary policy framework reviews help to ensure that frameworks keep up with evolving circumstances. But here too, approaches vary across central banks. In advanced economies, reviews have become more frequent since 2015 and have covered a wide range of issues, including objectives, the policy toolkit, and analytical techniques such as forecasting. These trends in part reflect the fact that advanced economies were at the epicenter of the great financial crisis. Many central banks in advanced economies enriched their policy toolkits to try to overcome the constraints posed by the effective lower bound. Emerging market economy central banks, in contrast, have been less likely to conduct policy frameworks reviews. Most did not face the specific challenges of extremely low inflation and policy rates, and their toolkits did not expand as much following the GFC. In addition, some emerging market central banks may have been more wary of putting the price stability objective at risk, especially if reviews open the door to broader short-term political considerations. Now let me address the 2021 framework reviews. Central banks in core advanced economies undertook major reviews of their monetary policy frameworks in 2020-21. These reviews took place under the shadow of lingering concerns about the extended period of low inflation after the GFC and the challenges posed by the ELB. The deflationary pressures at the start of the COVID-19 pandemic, alongside the perception that natural interest rates were trending downwards, added to these worries. Although commissioned before 2020, many of the reviews were conducted at the height of the COVID-19 pandemic as global economic activity came to a halt. At the time, it was hard to imagine that economies were on the cusp of the greatest inflation surge since the 1970s. There was also a broad-based perception that the Phillips curve had flattened. The weakened relationship between economic activity and inflation even suggested substantial policy stimulus was unlikely to trigger much inflation. Consequently, central banks were relatively unconcerned about the risks of inflation accelerating due to economic overheating. The reviews aimed to provide central banks with stronger frameworks to overcome the concerns posed by the ELB. In this context, they highlighted two key aspects for the future conduct of monetary policy. First, unconventional monetary policy tools, such as balance sheet policies, forward guidance, and in some jurisdictions, negative interest rates, became an integral part of the frameworks. Second, some of the reviews recommended greater tolerance for inflation overshooting. In particular, the Federal Reserve committed to allowing inflation to temporarily overshoot the target after periods of below-target inflation. It also adopted an asymmetric approach to labor market conditions, loosening policy in response to shortfalls from estimates of full employment, but not tightening when these estimates were exceeded unless this was accompanied by high inflation. For its part, the ECB moved from an asymmetric to symmetric 2% inflation target, responding to undershooting as well as overshooting. In its forward guidance, it also clarified that the need for strong monetary accommodation to escape the ELB could push inflation temporarily above target. Now, the COVID-19 pandemic unfolded as many central banks were conducting framework reviews. As economies shut down in response to a once-in-a-century pandemic, economies initially faced deflationary pressures. This put a premium on large and swift action. Central banks activated their full arsenal to support the economy and fight deflation with support from fiscal authorities. The support remained in place for an extended period. In part, this reflected the uncertainty about the length and impact of the pandemic, but it also reflected the spirit of the ongoing reviews that the risk of deflation at the ELB made a strong response necessary. Soon as economies were emerging out of lockdowns, the frameworks designed on the premise of persistently low inflation faced their first test in starkly different circumstances, the strongest inflation surge since the 1970s. While supply-side factors certainly contributed to high inflation, and in some jurisdictions may have been the dominant factor, the extraordinary monetary and fiscal stimulus also clearly played a role. Most importantly, the surge showed that the challenges to price stability were much more symmetric than had previously been thought. Initially, especially in advanced economies, central banks reacted with some delay. Inflation was perceived to be transitory, while risks to economic activity lingered. Emerging markets responded much faster than advanced economies, reflecting their greater perceived risks of transitioning to a high inflation regime due to less well-anchored inflation expectations. Nonetheless, when inflationary pressures ultimately proved persistent, even central banks that had previously committed to keeping policy settings loose for an extended period pivoted and reacted forcefully. The framework reviews probably also played a role in delaying the monetary response. Make-up strategies reinforced the perception that the largest risks to price stability were on the downside. As such, they provided the rationale for central banks to maintain expansionary policy settings even as inflation started to rise. But we should not overstate the contribution of the reviews to the inflation surge. They envisaged at most a brief period of modestly above target inflation. Faced with a large inflation surge, all policy frameworks called for tighter policy. Ultimately, central banks were somewhat slow to raise interest rates because inflation rose much faster and further than they had expected. The pandemic led to a unique combination of supply chain disruptions, changes in consumer behavior, a massive increase in energy prices due to the Russian invasion of Ukraine, and substantial fiscal and monetary stimulus measures. The analytical models used by central banks and other forecasters underpredicted the inflationary effects of these forces. This raises worthwhile questions of whether we can improve the accuracy and reliability of inflation forecasts. But it is not an indictment of monetary policy frameworks. Indeed, as soon as central banks realized the scale and persistence of the inflation surge, they tightened policy significantly. Then we have some liquidity. So let's go into the ongoing framework reviews. Having reflected on the past, let me now turn to the present. Several central banks are currently reviewing their monetary policy frameworks. This is timely given the insights gained from the post-pandemic inflation surge. The post-pandemic experience has shown that inflation risks are more two-sided than previously appreciated. Before the pandemic, the prolonged phase of low and stable inflation created the impression that strong inflationary pressures were a relic of the past, at least in advanced economies. Furthermore, there was high confidence in central banks' ability to preemptively head off emerging inflationary pressures by tightening monetary policy as needed. After all, while the ELB limits central banks' ability to ease monetary conditions, their ability to tighten policy is in principle boundless. The post-pandemic events served as a crucial wake-up call, demonstrating that inflation, even if dormant for extended periods, can suddenly resurface with vigor. The post-pandemic inflation surge also highlighted the need to ensure that the financial system can withstand rapid monetary tightening. The collapse of Silicon Valley Bank, the liability-driven investment crisis in the United Kingdom, and the unwinding of carry trades in August 2024 were stark reminders of the financial stability threats that can arise when monetary policy must respond to strong inflationary pressures. While higher capital requirements and improved supervisory practices since the GFC have strengthened the banking sector's resilience, vulnerabilities remain. Another important insight from the post-pandemic developments is the public's profound dislike of inflation. Persistently high inflation has led to significant increases in price levels. For example, consumer prices in the United States rose by 14% over 2021 and 22. Such an increase would have taken almost 8 years at pre-pandemic inflation rates. The inflation surge has also underscored that adverse supply shocks can trigger strong and persistent inflationary pressures. Central banks in emerging market economies have long been aware of these risks. However, in advanced economies, there was an implicit presumption that large and sustained deviations of inflation from targets could only be driven by demand-side factors. Consequently, central banks became accustomed to accommodating contractions in aggregate supply, expecting their inflationary effects to dissipate rapidly. The recent inflation surge has upended these views. The sharp rise in commodity prices following the Russian invasion of Ukraine and the pandemic-induced supply bottlenecks were major drivers of inflation. Although these shocks were extreme, monetary policy frameworks should be robust to handle the potential recurrence of such shocks, especially given the challenges posed by climate change and geopolitical tensions. The nature of the inflation surge has also demonstrated the importance of fiscal policy. Government responded forcefully to the pandemic by providing critical support to households and firms. However, in several jurisdictions, the size and persistence of fiscal spending boosted demand excessively, contributing to the inflation surge. A better appreciation of the inflationary consequences of fiscal spending is essential to better calibrate policy responses. Finally, perhaps the most important insight from recent events is the highly unpredictable nature of economic developments. As previously discussed, before the pandemic, there was broad-based agreement that the global economy would face strong deflationary pressures for the foreseeable future. Real rates were expected to remain at historic lows, raising the risk of persistent liquidity traps. The post-pandemic inflation surge and the concomitant increase in real rates have shattered this consensus. Economic conditions, even on a global scale, change much more rapidly and profoundly than most of us expected. Looking ahead, the potential for major turnarounds in the global economy remains very concrete, given the risks posed by geopolitical tensions, climate change, and the unknowns related to the development of artificial intelligence. So the insights from post-pandemic developments provide lessons for the ongoing framework reviews. At the same time, the reviews should not overlook the valuable lessons learned beforehand, even beforehand COVID-19, and should avoid overcorrecting frameworks that have generally been remarkably successful in guiding central banks' actions in recent decades. In the light of these considerations, I will highlight several issues that I believe deserve careful attention in the current reviews. These include rebalancing frameworks towards the risks of inflation surges, reducing the reliance on tools that are difficult to adjust, enhancing communication strategies, maintaining a realistic perspective on what central banks can and cannot achieve, and ensuring robustness to a broad range of possible economic developments. Let me elaborate on each of these points. The post-pandemic experience calls for rebalancing the frameworks towards the risks posed by inflation surges. Frameworks must still allow central banks to respond forcefully to ELB risks, but they should also allow for decisive monetary tightening when inflation rises above target, especially if it threatens to the anchor expectations. To this end, it seems particularly important to reconsider the merit of made-up strategies that commit central banks to compensate inflation undershooting with subsequent overshooting. The post-pandemic experience calls for greater caution in letting inflation rise above target, given that it may surge much more strongly and swiftly than warranted. The stronger public resentment triggered by the inflation surge also suggests that letting inflation rise above target risks undermining public support for central banks and possibly even threatening their independence. A rebalancing of the framework is also warranted given that inflation undershooting appears less damaging than previously feared. The Great Depression revealed the severe consequences of deflationary spirals. However, prolonged periods of below-target inflation before the pandemic did not lead to strong deflationary dynamics. This can be partly credited to the monetary policy accommodation provided by central banks. More generally, inflation appears to be self-stabilizing at low levels as prices and wages rarely fall. In technical language, they are downwardly rigid. This rigidity also allows central banks to be somewhat tolerant of modest shortfalls in inflation from target, especially when economic activity is resilient. Another reason for central banks to tolerate inflation modestly below target is that prolonged policy accommodation tends to face diminishing returns in boosting inflation and stimulating the economy. Furthermore, it risks building financial imbalances by encouraging the build-up of private and public sector leverage, a particularly concerning side effect at this juncture, given historically high levels of debt in many countries. Turning to central banks' policy toolkit, framework reviews may want to underscore the importance of exit strategies and prioritize instruments that can be adjusted flexibly. The macroeconomic outlook can change abruptly, and monetary policy must be able to adjust. The policy rate should thus remain the primary tool to conduct monetary policy. Outside of the ELB, it can be adjusted nimbly in both directions, strongly influencing financial conditions through well-understood channels. Central banks could use greater caution in deploying their balance sheets. While asset purchases are crucial during periods of acute financial distress to preserve financial stability and strengthen monetary policy transmission, their use outside of crisis episodes is less clear. Large-scale asset purchases face diminishing marginal returns in stimulating the economy cannot be unwound rapidly without raising financial stability concerns and may expose central banks to large financial losses. 1 second. The reviews may also want to emphasize the importance for forward guidance to be state contingent, making it clear that statements about the future policy path are dependent on economic developments. Forward guidance is helpful to clarify the central bank's policy reaction function. It also provides useful indications of how policy rates will evolve if economic conditions align with baseline forecasts. This is particularly important in the ELB context, where the central bank may want to underscore its intention to keep policy rates low until inflation moves towards target. Admittedly, delivering state contingent forward guidance can be difficult in practice. Markets often interpret signals about the likely evolution of policy rates as hard commitments, independent of economic developments. This may unduly constrain central banks' ability to change course if inflation picks up faster than expected. This highlights the need to further improve communication by better conveying the intrinsic uncertainty surrounding policy decisions. Central banks have made remarkable progress in engaging with the public and clarifying the goals and conduct of monetary policy. This has greatly helped to anchor expectations and enhance monetary policy transmission. However, attempts to clarify the stance of monetary policy and the central bank's assessment of economic outlook may convey a false sense of certainty among market participants and the public. To avoid this, central banks should strive to better convey the uncertainty surrounding the economic outlook. To highlight the role of uncertainty, central banks could rely more on scenario analysis to illustrate how the economy and hence monetary policy could evolve if specific risks materialize. Yet, central banks must carefully assess the costs and benefits of alternative communication strategies, as scenarios about adverse events could spark public attention and potentially trigger self-fulfilling events. More generally, ongoing framework reviews must remain grounded in realistic views of what monetary policy can and cannot achieve. Monetary policy should focus on objectives it is well equipped to achieve, such as price and financial stability. Expanding central banks' objectives without adequate tools raises reputational risks and can undermine credibility and independence. In particular, monetary policy should not be tasked with acting as a de facto engine of growth or pursue objectives that may pose trade-offs with price and financial stability, such as inequality or overly ambitious climate change agendas. Additionally, it is essential to resist pressures to use monetary policy to stabilize continuously financial markets. Central banks have a critical role to play in protecting financial stability at times of acute crisis, but they should not be tasked to systematically prevent asset price declines, since these are essential to ensure price discovery and the efficient allocation of financial resources. Finally, I would like to stress the importance of ensuring robust monetary policy frameworks. The reviews should obviously be informed by the challenges of the post-pandemic inflation surge and the low inflation era that preceded it, but the future will undoubtedly bring new economic circumstances. We must avoid fighting the last war. Frameworks should provide general principles to help central banks navigate the extremely uncertain landscape ahead. In this context, strategies that create and preserve monetary space are critical to deal with the unavoidable occurrence of large and unforeseen shocks. In sum, the agenda for the ongoing framework reviews is rich and challenging. These reviews will grapple with complex issues, and the specific conclusions will naturally depend on country-specific conditions, notably the macroeconomic landscape and institutional features. However, I am confident that central banks will seize the opportunity to make further refinements to their frameworks. As I mentioned before, this is the perfect time to engage in such critical discussions. Lastly, I would like to underscore that the success of monetary policy does not rest solely in the hands of central banks. For central banks to achieve low inflation and financial stability, it is essential that fiscal policy ensures public debt sustainability. The sharp increase in public debt levels in recent years in many countries, coupled with large and persistent fiscal deficits, poses significant concerns. Growing fiscal needs linked to population aging, the green transition, and geopolitical tensions add to the challenges. Correcting fiscal imbalances is of critical importance for central banks to continue delivering on their mandates. Thank you very much.
Well, thank you, Agustín. That was a very, very timely and useful tour de force on the last few decades and the future. So I'm really grateful for that. Let me just see if there are any questions from the audience. If not, I can always begin by asking a couple of softball questions just to get the conversation going. No questions from the audience? Okay, we got one in the back.
Me? Okay. So I was very happy to hear the little part at the end about fiscal policy, because I think that's the elephant in the room. And I have the feeling, I'm not a macroeconomist, but I have the feeling that central banks can affect the timing and the nature of the pain that we have from huge deficits, but they cannot completely neutralize them. And I think that there's a communications rule for explaining to people what is the role of the central bank and what is the role of fiscal policy. Do you agree? Or?
Well, definitely I agree with that. I mean, obviously, I have been impacted a lot by my experience in my own country, where, by the way, I was both Minister of Finance and Central Bank Governor. So
at different times.
At different times, yes. So I like to say it's not the same to be a bartender or to be a drunkard. So I have seen the game from both sides. At the end of the day, you know, inflation and growth, employment and so on are such broad variables that they definitely depend both of the interactions between fiscal and monetary policy. So, I mean, I think it's very difficult to establish a monetary policy framework without clear consideration of fiscal policies. Conditions in Mexico allowed us to be relatively open to this. And, you know, for example, if you see, and this is a case that is also replicated in many emerging markets, we tend to have an inflation target that is slightly above the one of advanced economies. And fundamentally, that is because we have fiscal weaknesses that traditionally are not present in advanced economies. And well, of course, you know, to push inflation below, in the case of Mexico, for example, we don't have 2% of a target, we have 1 at 3% with the plus minus band, so 4% is the maximum acceptable inflation. to push inflation below 4% without a clear determined fiscal objective is very, very difficult. Now, at least we managed to have this dialogue with the government. So to achieve the 4% seemed to accumulate enough consensus that it becomes credible. That is not optimal, of course, because also that is reflected in higher real rates of interest. Now, the economics is not much different in advanced economies, So it's very difficult for institutional reasons to really discuss about coordination among policies, because at the end of the day, there are different instruments, there are different governability, there are different horizons. But at least there should be a frank explanation when fiscal and monetary policy are working cross currents. Because at the end of the day, that's also a choice that society have at a broader level, and they should know about it. So, for example, in the case of Mexico, we try to be very fair in our assessment about fiscal policy. Sometimes we applauded fiscal actions. Like, for example, there was a time where there was an important tax increase, and through the value-added tax, that increased measured inflation in the short term. It generated a deviation from our band, but we came out and said, the government is doing great. Yes, inflation was caused by the imposition of value-added. We will not fight it because it's a once and for all increase in prices. But for the long term, this is very good for inflation. It will strengthen the fiscal position in the long term. It will strengthen the sustainability of the debt. And this is a great measure, and this should, as a matter of fact, reduce the real rates of interest in Mexico in the long term. And it played out really nicely. Other times we had to be a little bit more critical when, for example, the primary deficit increased substantially. And we had to say, look, this will create additional demand pressures on prices, and we might have to come out and combat them. So, I know that in different places, the dialogue is not that easy. But in principle, I would say that if you can have that debate in the public, in the open, I think should be welcomed.
Thank you, Agustín. Any further questions? I think I saw one. Please.
Hi. I'd like to ask a question about the supply and demand graph. I was just wondering, as I looked at it, it struck me that both the supply and demand factors tended to be pushing up inflation. And I haven't looked at these aggregate methods of decomposing into supply and demand factors, but I have looked at them for individual markets. And it seems to me that supply factors should be basically something like real growth or productivity growth, something like that, which I would expect to be positive on average. But in that graph, so positive on average, so reducing inflation, right? But in that graph, the supply factors were positive on average, which suggests to me that on average, it was harder and harder to make stuff. And that kind of surprised me. What am I misunderstanding here?
Well, I will ask my support team to answer that question. I will pitch in later, but here is Dan Reis, my chief of staff. He knows a lot about these numbers. So I will share the pain with him.
Okay, I'll talk to him later.
Maybe we can talk later. The technical reason is there's a constant embedded in both the supply and the demand. If you took the deviation from the constant...
There is a microphone.
Sorry,
why don't you explain?
The technical reason is there's a constant embedded in both the supply and the demand. If you took that out, then indeed, as you say, the supply factors would be, well, they'd be both positive and negative, because the productivity, for example, it boosts supply, which helps lower inflation, but demand responds as well. So But maybe we can talk afterwards about the specifics of that.
Okay, thank you for that question. Any further questions? I think, sir.
Oh, there he goes.
Conversation and to some extent about interest rates as the response. Balance sheet of the Fed.
Let me just paraphrase the question so that everybody can hear. So the question was, primarily the primary policy tool are interest rates, and the question is, could you speak about the balance sheet of central banks, in particular the Fed, and how do you think of that in terms of effects on inflation? Did I get that right? Yeah, you can.
Well, I definitely try to present a broader picture of the challenges of central bank and not necessarily focus on the Fed. Of course, the most important central bank in the world is the Fed, and you set the tone in many different discussions. Now, the way I see it is the following. The central bank, what monetary policy is the ability of the central bank to use its balance sheet and the terms at which it affects its balance sheet. The interest rate policy, doesn't work independently of some form of balance sheet implications. In the speech, basically what I try to address is the importance of monetary policy framework reviews. Why this is important? Because inflation targeting regimes that are basically the predominant regimes in most central banks, it's a very primitive way to try to anchor inflation expectations. It's basically to say to the public, this is my inflation objective, and in principle, I will do whatever it takes to hit that target. But we never are that specific about it. Now, by construction, that has its advantages, but it also has its disadvantages. So basically, I think through the monetary policy framework reviews, you fill the gaps of information. Now, if you consider that central banks should be flexible in the use of their instruments, they should have flexibility in how they use it, both in interest rates and in balance sheets. Now, I'm not somebody who is inclined to establish quantitative targets on quantities, because the traction of that on the final objective is relatively low. Now, I think that under certain conditions, the use of balance sheet tools like quantitative easing was done to an excess due to the concerns of the ELB, and in principle, some form of a correction should take place. But at this stage, it should be gradual and is not of first order of importance. I think it's something that through time it can be dealt with, and I don't think that necessarily it compromises the integrity of the monetary policy framework. My recommendation for the future is to try to depend less on quantitative-based measures and depend as much as possible on interest rates and probably forward guidance.
Thank you, Agustin. We have time for one more question. Would anybody like to be the winner?
So you mentioned, you provided the example of the increase in the value-added tax in Mexico as a one-off increase. How, probably you know where this is going. How about tariffs? Would this be viewed as a one-off increase from a US standpoint? What's your view on that?
Well, yes, I mean, this will be a once and for all change. Now, what is important, and I think this is associated to what I said about commodity prices and supply chain shocks and so on and so forth. What the U.S., well, and in general, whatever country is affected by this, I mean, in this case, mostly it will be Mexico and Canada. Well, Mexico today we had some relief, so that's good. But we don't know. I mean, at the end of the day, the final impact on inflation probably will be a once and for all. It's difficult to estimate because it's a tax, and the incidence of a tax, you don't know exactly how it will be shifted. In international aspects, you also have the consideration of the exchange rate, and so how will that play out? So I think in general, the recommendation would be to not immediately tighten unless there is evidence that that is contaminating price formation in other ways, and the impact is going beyond what would be reasonable to expect. If it's affecting expectation formations, and if it's threatening to the anchor inflation expectations, I think there should be a tightening, but it shouldn't be a knee-jerk immediate reaction.
Thank you, Agustin. So I think we still have a couple more minutes, so this is so good, I'm gonna keep it going for one more round. So any further questions? This will be the last one. Okay, one in the back.
Yeah, thank you. So in your presentation, you warn about central bankers being too certain in their outlook, and they should show more uncertainty. But economists generally believe that policy needs to be forward-looking, and so we need to anticipate what's going to happen. And yet the models don't seem to be up to it. So how does a central banker walk through this minefield? If they need to be forward-looking and making policy, but if you think they need to be less certain and convey that to the public, what's the solution for them to run policy, and how do they convey that to the public?
Well, I mean, you can have a forecast, and you can have different models that give you the forecasts. But what I recommend also in my speech is to use some form of scenario analysis. What if type of questions, you know? So if something happens, even if it's not the central scenario, how would I adjust monetary policy? And probably open this to the public, you know? I mean, we don't know what will happen with the price of oil. We don't know what will happen if something, for different reasons, there is I mean, how about there is a very large fiscal expansion and that affects price formation? How would central bank respond? So given that there is uncertainty, and given that to depend only on forecasts is risky, to have some form of a dialogue around scenario analysis, I think would be important to do.
Well, all good things must end, so I'm sorry we're running out of time. I'll say, Agustin, thank you for a fantastic lecture, incredibly comprehensive.
Thank you. Thank you.